£60,000. That is the difference between a couple who get the paperwork right and a couple who do not. Same house, same marriage, same estate. One set of wills directs the property correctly, the other does not. £60,000 to HMRC on the second death. Not bad luck. Not complicated finances. 4 specific things still pointing the wrong way. Most married couples in the UK are about to give HMRC £60,000 they don't have to. 4 things in their estate are still pointing the wrong way. None of those 4 things will arrive in a letter. I spent close to 30 years inside HMRC, 8 of those in the Pensions and Investments Compliance Unit, then as a senior investigator, then on the team that wrote the internal guidance used when inheritance tax cases became complicated. I have sat with hundreds of ordinary families at Citizens Advice, couples in their 60s and 70s who built their estates carefully over a lifetime and then watched tens of thousands of pounds go to HMRC for want of a will review and a single phone call. The rules that could have protected them were on the books the entire time. I'm not on the payroll anymore, which means I can finally say a few things I wasn't allowed to say before. 1. The will is not pointing at the children. It is pointing at the tax bill. Every married couple in this country can potentially pass up to £1 million to their children free of inheritance tax. The house, the savings, the ISA, all of it. Not through anything complicated, not through offshore accounts or clever structures, simply by having the right words in the right wills before the first one of them dies. And here's the bit nobody explains. The residence nil rate band, worth £175,000 per person, £350,000 combined for a couple thou, only applies if the main home passes to a direct descendant. A child, a stepchild, a grandchild, not a sibling, not a niece, a direct descendant. Most solicitors do not explain this at the point when couples are sitting in their offices. They draw the wills pass. Nobody asks whether the residence nil rate band has been specifically addressed. If the will leaves the estate to the wrong person, or simply does not address the residence nil rate band at all, that £350,000 of extra threshold is lost. At 40% on the excess above the standard nil rate band, that is potentially £140,000 to HMRC that did not have to go there. The number that matters for most ordinary couples is this. Take a couple with a house worth £600,000 and ISAs and savings of another £200,000. Total estate, £800,000. With the right wills in place, wills that direct the home to their children on the second death, their combined threshold is £1 million. Inheritance tax owed? Nothing. With the wrong wills, or wills that simply do not address the residence nil rate band, the combined threshold drops to £650,000. Inheritance tax at 40% on the remaining £150,000, £60,000 to HMRC. Same couple, same house, same 40 years of saving, different paperwork. I sat with a couple I'll call Henry and Ruth at Citizens Advice, both in their early 70s, house worth £580,000, ISA savings of £180,000, total estate £760,000. Neither had reviewed their wills in 14 years. The wills left everything to each other first, then on the second death to Henry's brother. Not the children, the brother. The residence nil rate band could not apply. The bill on the second death was £44,000. It could have been nothing. Our solicitor drew them up years ago, Ruth said. We just assumed they were right. An assumption is not a will review. A will review takes one conversation and costs far less than £44,000. Don't be Henry and Ruth. Ask your solicitor one specific question this month. Do our current wills ensure the residence nil rate band is fully available to the surviving spouse's estate on the second death, with the home passing to our direct descendants? Get the answer in writing. Scotland. Inheritance tax is a UK-wide tax. The residence nil rate band applies in Scotland. Scottish succession law differs in some respects, so take specific Scottish legal advice on how your will achieves this. Right. 2. The house is still held as joint tenants. That could cost your children half of it. Most married couples in England and Wales own their home as joint tenants. That is almost certainly how yours is held right now. Joint tenancy has one rule. When one of you dies, the other takes the whole property automatically, regardless of what the will says. The house passes by survivorship before the will even comes into play. And here's the bit nobody explains. When the first of you dies and the whole property passes to the survivor now owns all of it in their sole name. If they subsequently need residential care, a fall, a dementia diagnosis, a stroke, the local authority carries out a means test. In England, the capital threshold is £23,250. Above that, you fund your own care in full. Residential care now costs more than £1,400 a week on average. A home worth £250,000 can be gone in under 3 years. The equity you spent your working life building can be consumed entirely. And it happens to thousands of families every year because nobody explained how the ownership was held. 2 steps change that entirely. First, a deed of severance, which converts the ownership from joint tenants to tenants in common, giving each of you a defined share. Second, a will that includes a property protection trust. When the first of you dies, your share does not pass outright to the survivor. It goes into a trust. The survivor has full rights to live in the property, to sell it and move, to treat it as their home in every practical sense. But the trust's share is not in their name. It cannot be counted in a means test. When the second of you eventually dies, the trust ends and the share passes to whoever you named. I sat with a woman called Margaret at a Pensionwise session, 74 years old. Her husband had made a will. He had spent his last weeks reassuring her that everything was sorted. The house was held as joint tenants. By the time she came to see me, the survivorship had already happened. The whole property was in her sole name. The will had never had the chance to operate. Everything he had intended to protect was now fully exposed. He kept saying it was all fine, she said. He was very organized about everything. He had made a will. He had paid a solicitor. He had reassured her. He simply had not asked one question about how the property was held. It was not fine. Don't be Margaret's husband. Find out this week how you hold the property. Ring your solicitor or check the title register at gov.uk/search-property-information-land-registry. A small fee reveals whether you are joint tenants or tenants in common in plain text. If you are joint tenants, ask your solicitor about a deed of severance and a property protection trust. The severance is a form. The trust goes inside the will. Both are needed, and neither works without the other. Scotland. Scotland has different rules on care costs and property law. The concept of joint tenancy does not apply in the same way. Take specific Scottish legal advice rather than applying what I have just said directly. Now. 3. The pension nomination is out of date, and April 2027 is coming. Most couples know their pension is important. Most have not looked at the nomination form in years, and from April 6, 2027, the stakes on that form change fundamentally. And here's the bit nobody explains. For decades, unused DC pension wealth sat entirely outside the inheritance tax estate. Pension death benefits are paid at trustee discretion, not as of legal right, which is precisely what kept them outside the estate. A SIPP worth £300,000, properly nominated, passed to children with no inheritance tax at all. From April 6, 2027, 11 months away, that changes. Unused DC pensions will be brought inside the inheritance tax estate for the first time. If the pension has already consumed the available threshold, a £300,000 SIPP generates a £120,000 tax bill, where today the bill is nothing. And the nomination form becomes even more critical. If the form is out of date, names a deceased parent, or has never been completed at all, the trustees will make their own decision about who receives the benefit. That might be the right outcome. It might not. Either way, You have given away control of what could be the most valuable asset you own. I sat with a couple I'll call David and Sylvia at Pensionwise this year, both 67. David had a SIPP worth £275,000. The nomination form named his mother as the sole beneficiary. She had died 4 years ago. Sylvia was not mentioned. "We've been married 31 years, Sylvia said. "I didn't even know there was a form." There was a form. It was pointing at a woman who had been dead for 4 years, and the trustees would have had to use their own discretion to decide where £275,000 should go. Don't be David. Ring your pension provider this week. Say, "I'd like to review and update my expression of wish on this pension. Can you tell me how to do that?" 20 minutes. Free, both of you. Every pension either of you holds. Scotland. Pension nominations apply UK-wide. The April 2027 IHT changes, and the urgency around nominations apply equally in Scotland. Right. 4. The gift exemption is being wasted while both of you are still well, £3,000. That is what every individual in this country can give away each year, completely free of inheritance tax. No 7-year clock, no form. Exempt the moment it leaves the account. For a married couple, that is £6,000 per year, quietly reducing the taxable estate, year after year, with no record required and no tax consequence of any kind. And here's the bit nobody explains. Most couples mean to start. They keep meaning to start. And the annual exemption is not the only tool available. Larger gifts start a 7-year clock. Survive 7 years, and the gift falls outside the estate entirely. Between years 3 and 7, taper relief reduces the potential charge progressively. A gift made today at 68 clears at 75. Comfortable. A gift made at 78 after the diagnosis, after the fall, after the appointment, that is a different and much harder calculation. The clock only runs from the date the gift is made. HMRC does not need to act quickly. It just needs to wait. And there is a second exemption almost never mentioned. For couples whose pension income genuinely exceeds their everyday spending, gifts made regularly out of surplus income, as part of a clear and habitual pattern, are entirely exempt with no upper limit. No clock, no ceiling. Keep a simple record of the amounts, the dates, the pattern. HMRC will ask for it. I sat with a couple I'll call Edward and Joan at Citizens Advice, both 75. Their estate was worth £950,000. They had given nothing to their children in the 7 years since Edward retired. Not because they did not want to, not because they were cautious, because nobody had ever explained the annual exemption to them, and nobody had explained the 7-year clock. "We've been meaning to see a financial advisor for years," Edward said. "We just never quite got there. 7 years of annual exemption, gone permanently. £84,000 in gifting that would have cleared the clock. Never started. The gifts they could have begun at 68. They were starting at 75. Don't be Edward and Joan. Start this tax year. Give £3,000 each, or up to £6,000 each if last year's allowance is still available. For larger gifts, speak with a qualified independent financial advisor about the 7-year clock and the surplus income exemption. The best time to start was 10 years ago. The second best time is now." Scotland. The annual gift exemption, taper relief, and the surplus income exemption all apply UK-wide. Same rules, same records, same urgency in Scotland. The system runs on what you ask for, not on what you're owed. Get the wills reviewed and confirm the resident's nil rate band is specifically secured. Find out how you hold the property and ask about the deed of severance and property protection trust this week. Update every pension nomination form, both of you, every pension either of you holds. Start the gift exemption this tax year, not next year, this one. That is where we started. £60,000. The difference between a couple who asked the right questions and a couple who assumed everything was fine. Same house, same marriage, same 40 years of building something together. One couple reviewed their wills, updated the nominations, and started the gifting. The other assumed their solicitor had it covered. The solicitor drew up the wills 15 years ago and has not been asked since. These are not loopholes, they are the rules, written into law, available to every married couple in this country, and requiring nothing more than a will review, a phone call, and 20 minutes on a pension provider's website. They disappear quietly when nobody asks the right question at the right time. Take care of yourselves. And take care of each other. I should say, as I always do. Nearly 30 years inside HMRC, and now a citizen's advice volunteer. Nothing here is regulated financial advice. For your specific circumstances, wills, property, pensions, gifting, speak with a qualified independent financial advisor and a solicitor. Book a free Pensionwise appointment if either of you holds a defined contribution pension. Government-backed, for the over 50s. The number is 08-00011-3797. All links are in the description.